All right, guys, this is Christian from Tribeca Trade Group, and this is a video regarding strategy in this market environment. A couple different option trades or an option structure that you could use to to tackle this environment, and I'll explain why. So what do we know right now? We've had a decent pullback. We're into the 200-day moving average. We broke the 200-day moving average yesterday. We know that volatility is heightened, much higher than it was a few months ago. So that we know that we're dealing with a higher cost in option prices. If you're an option trader, which I know a lot of you are, most of you are, who are subscribers, who are trading options, the one thing that you know right now is that the cost of options is more expensive than it was a few months ago. So it's a lot harder, it's a lot more expensive to play the game, to participate right now in trading. So one of the structures that I like to use in this environment is a limited risk reversal. And I'm going to go over the structure. I'm going to go how to use it, or how it's used, why I'm using it, and why I'm using that right now in this current right into this pullback right now. All right, so I'm going to go over the exact trades that I put on. If you've already heard me talk about these trades earlier, as I detailed these in our midday session in the Tribeca Trade Room, you could skip this video. But if you didn't catch it and you want to see what these trades are and the structure, then you can go ahead and watch this video. All right, so we know, first of all, this is the VXN, this is the VIX up here. I've got them on different time frames, but bottom line is we're in a higher volatility environment right now. It's a lot different than it was. And yes, option prices are more expensive. So what I want to do is take advantage of that. I want to use what we know, that the option premiums are more expensive, and I want to structure trades that I can actually profit if I get the direction of the trade correctly. All right, so here's a couple trades that I worked out. So I'm going to talk about what's known as a limited risk reversal. So before I go into a limited risk reversal, first of all, what is a risk reversal? Right? It's basically replicating a stock strategy with leverage. Right? You're buying a call and you're selling a put. Right? When you buy a call, you have complete upside potential. And you also, when you have that, you have the cost of the premium. So once you get past the strike price and the cost of the premium, then you have unlimited upside potential. When you sell a put, what you're doing is you have risk to the downside, right? You're collecting some premium, but you have risk all the way down to zero. And so that's replicating when you sell the put and you collect a premium and you use that premium for right around the same prices to buy the call, you're basically replicating a stock strategy, right? You profit when the stock goes up and you lose money when the stock goes down. But in options you have leverage, right? So that, I think, is a pretty risky strategy, especially in this environment when the volatility is higher than normal. What I like to do is cap the downside. So I call it a limited risk reversal. And what I'm doing is the same thing. I'm buying a call, but instead of using just a short put to finance the price of the call, what I'm doing is I'm selling a put spread, and usually around $5 wide. So this way I know exactly what the risk is. I'm defining the risk, limited risk. So that's the structure. So the best thing I could do is kind of walk you through a couple examples why I chose these three trades that I'm going to go over. So clearly we've had a pullback, and I want to take advantage of the pullback, right? Everybody always says, oh, if I could only have a pullback, I would buy in here, right? The problem is that we really don't have any confirmation that we're not going to go lower. We don't know that the bottom is in. So this way, in these three trades, I'm defining my risk. I know how much I can lose, but I'm taking a little bit of a shot here. Okay, so Workday. We know that Workday had good earnings. It rallied into earnings. It's come down significantly from 140 all the way down to 124. So, about a good 10% correction in the stock. So what am I doing here? All of these three trades that I'm going to talk about, Workday, BABA, XBI, you don't have to worry about because it doesn't report earnings, but they're not going to include the earnings period. So the expiration will come before the company reports earnings. So Workday, I'm going to the May expiration, and I'm buying a 135 call, which is up here, And then what I'm doing, and that cost me 298, so $298. And what I'm doing is I'm selling a put spread, the 125 120 put spread, and I'm collecting $216, right? So the net cost of that, what is that? 298, so about $80. That's costing me right out of pocket. So if the stock really does nothing, I do need it to go above 125 by expiration, but let's say it goes above 125, my total outlay is $80. I'll lose $80. My total risk is if Workday closes below 120 by May option expiration, I'll go ahead and lose $582. How am I getting that? It's the distance, the price, or the width of the short put spread, which is 125 minus 120. It's $5 minus the 216 that I'm collecting, right? So that's 284. Plus, I had to pay for the call for 298. So you add the price of the call minus the width of the put spread minus the premium that I'm collecting, and gets you to $582 per one lot. That's all I'm doing is just a one lot. This way I'm defining my risk. The most I could lose, I could lose there is $582. That's it. So there will be no stop on these trades. The stop is the premium. I'm risking $582. So if it happens to go down a couple dollars, I'm not going to go crazy saying, oh, it's down $2, it broke support, I'm going to get out because I don't want to lose everything. No, in this sense, that's my stop, $582. You have to be comfortable with losing the whole premium, right? So that's the risk of using this option trade. So again, I'm not throwing away, just a whole bunch of money, taking a shot at these trades. The most I can lose is $582. The reward is if it closes, in a month and a half. So I'm using April, which I believe is one of the strongest seasonal months of the year for equities. So I'm taking advantage of that we know that it's historically a strong month. And I'm going out about 6 weeks thinking that we're going to get through this volatility maybe in the next week or two. And then I'm looking for a rally post that, right? So I've got about 6 weeks for expiration for this trade, and I'm looking for this to get above 135. Any price above there, straight above 135, I will start to make money past that $80 of outlay. All right, so that's the first trade, workday. Notice you have the 50-day moving average, which it's right around. BABA. This one I'm risking a little bit more money just because the strikes didn't set up correctly, but my thought process is here into the 200-day moving average, right? So into the 200-day moving average support. Is it going to hold? This is a trade for a hold of the 200-day moving average. If it breaks, and I'm going to lose on the trade. That's it. That's the end of the story. Taking a shot at a defined level. My risk on this trade is $1,000. Why is it $1,000? Because I'm shorting 2 contracts and I'm collecting $460 on the put side, and I'm just buying 1 contract, which costs $500. So just to kind of give you a scenario analysis, if the stock finishes above 177.5 by May 11th, I chose May 11th because BABA reports shortly thereafter, and the monthly expiration is not going to work. Again, I don't want that to cover the earnings. So if BABA ends up above, let's say, 177.5, I'll lose $40. Right, the difference between the 460 and the call. What I really need is this stock to get back above 187.5. There, I make money. All right, and I've got unlimited upside if it really rallies. And then third, I chose a sector ETF, biotech, which is also, I think, oversold at this point into the 200-day moving average. Could be a little bit of a double top that's set up here, but I would be looking for a rebound. Similarly, what I'm doing here, just a one lot. I'm only risking $534. So I'm going to try to keep these trades for the most part, around $500 of risk. If I really like to set up, I'd like to set up in BABA a little bit more, risking $1,000 in that trade, and that's it. And again, I'm selling a May 86.81 put spread there, and I'm buying a call. So same type of philosophy in that XBI trade, and And then, so that's my strategy, taking a shot after a big, decent pullback. And then, my strategy during the day for day trading, because these are more swing trades, is when we see a little bit of a spike up in volatility, just like I did this morning, is to buy buy some index puts to shield against and to profit from a increase in volatility. VIX started to really ramp a little bit. I bought some SPY puts, profited on them. I think you could see this in here. Paid 233, sold for $3, right? So that will counteract, any further volatility that we have on the downside. I'll be using throughout the days for the next, at least until this volatility is still present. That's a strategy that I will be doing during the day, is scalping index options. All right, so hope you enjoyed the video. You could email me or certainly hit me in the trading room. Any questions about the structure? And I will send out an email now with the details of this. Thanks very much for watching, and enjoy the rest of your day.